Have you ever wondered why the price of your favorite coffee changes? It can be puzzling to see the same cup of coffee cost more or less on different days, or why gasoline prices seem to go up after a hurricane. These fluctuations can feel unpredictable and frustrating. The answer lies in two fundamental forces that drive any economy: demand and supply. These forces are constantly at play, influencing prices in ways that might not be immediately obvious. Understanding these forces is crucial, whether you're a consumer trying to make sense of price fluctuations or an investor navigating the stock market. It helps to know what drives these changes. In this essay, we'll delve into the basics of demand and supply, explore how they interact to determine prices, and examine their real-world implications. We'll break down complex concepts into easy-to-understand ideas. Understanding how demand and supply work can be incredibly empowering. It gives you the tools to anticipate and react to price changes. It allows us to make informed decisions as consumers and investors. With this knowledge, you can better manage your finances and investments. So, let's dive in and demystify these economic forces. By the end, you'll have a clearer understanding of why prices change and how you can use this knowledge to your advantage. Demand refers to the quantity of a good or service that consumers are willing and able to buy at a given price. It reflects the desire and purchasing power of consumers in the market. The law of demand states that generally as the price of a good increases, the quantity demanded decreases. This inverse relationship is a fundamental principle in economics. Imagine your favorite brand of chocolate bar goes on sale. The lower price makes it more attractive to buy. At a lower price, you're likely to buy more. This is a clear example of the law of demand in action. This illustrates the inverse relationship between price and quantity demanded. As prices drop, the quantity demanded rises and vice versa. Supply, on the other hand, is the quantity of a good or service that producers are willing and able to sell at a given price. It represents the production side of the market. The law of supply states that as the price of a good increases, the quantity supplied also increases. Producers are motivated by higher prices to supply more. Think about a farmer who grows apples. The price of apples can significantly impact the farmer's production decisions. If the price of apples rises, the farmer is incentivized to produce more apples to maximize profits. Higher prices lead to increased supply. The point at which the quantity demanded equals the quantity supplied is called equilibrium. This is where the market naturally settles. At this price, the market clears, meaning there's no shortage or surplus. Both consumers and producers are satisfied, achieving a balanced market. Now let's apply these concepts to the stock market, where the principles of demand and supply play out in real time. A stock represents ownership in a company, and its price fluctuates based on, you guessed it, demand and supply. This dynamic nature makes the stock market a fascinating place. When more investors want to buy a particular stock than sell it, the price goes up. This is often driven by positive sentiment or news about the company. Conversely, when there are more sellers than buyers, the price goes down. This can happen due to negative news or poor performance. Several factors influence demand and supply in the stock market, including economic indicators, market trends, and global events. Positive news about a company's earnings, a groundbreaking new product, or strategic partnerships can boost investor confidence. Favorable economic conditions can increase demand for its stock, driving the price up. Conversely, negative news, economic downturns, or increased competition can lead to a decrease in demand, causing the stock price to fall. Understanding these factors is crucial for any investor. Section 4, Real-World Applications, from gas pumps to Wall Street. Let's look at some real-world scenarios. Remember the hurricane we mentioned earlier? When a hurricane disrupts oil production, the supply of gasoline decreases. However, the demand for gasoline remains relatively constant, as people still need to fuel their cars. This imbalance between supply and demand leads to higher gasoline prices. Similarly, stock market crashes often occur when a significant event triggers a sudden decrease in demand for stocks across the board. The 2008 financial crisis, for instance, was fueled by a collapse in the housing market, which led to widespread panic and a mass sell-off in the stock market. Section 5. The invisible hand at work. In conclusion, demand and supply are the invisible forces that shape market prices for everything from coffee to gasoline to stocks. Understanding these forces is essential for navigating the complexities of the economy, whether you're a consumer making purchasing decisions or an investor aiming to build wealth. By observing the interplay of demand and supply in our daily lives, we can gain valuable insights into how markets function and make more informed choices. So, the next time you notice a price change, take a moment to consider the forces at play. You might be surprised by what you discover about the invisible hand of the market.